Thank you so much for coming.
Pleasure.
Actually, you're coming from the emerging market world, that world, and now you're in the U.S. And I'm going to ask you U.S. questions because it concerns and relates to the other world as well.
Sure. I'm actually just back from the Middle East. I came through Istanbul on the way home. Love Istanbul, and got back into the US last week. So it's good to be back, but I do love that part of the world.
Well, it's good to have you back.
Thanks for having me.
The U.S. markets are flat, are mixed right now because of the news, because of the expectations. We are going to have the FOMC minutes soon. What are the expectations? The market is a little jittery, nervous. Are we going to read through the lines? What do you expect?
I think it's the million-dollar question. I think if Bravo TV got hold of this as a reality TV show, it'd probably be one of the best-selling shows on the market at the moment. Look, investors don't like nerves, and at the moment, confidence in where we see fiscal and monetary policy next year, I think, is very, very mixed. If we look at what we're seeing at the moment in terms of Yellen, she's made it quite clear that asset purchases to the tune of $85 billion that we've seen for a while now are going to continue until we hit one of the dual mandates of the Fed Reserve, which is a 6.5% unemployment rate. I think the other mandate which they've got, which is controlling inflation, I think Yellen's made it quite clear on the unemployment. That's fine. I think we're still a bit hazy in terms of what we're expecting from inflation and where we see inflation to go. And I also think there's questions to be asked about the effect of asset purchases or quantitative easing on what it's doing to inflation, because in theory, QE should be stimulating inflation. You increase money supply, you're going to increase prices. But I think there's some quite good data out there which we can maybe talk about later to say that it might be suppressing inflation and actually causing deflation by creating an excess in the markets, especially in places like China. So that's the first thing. But I think what we need to do is take a step back outside of monetary policy and look at what the macro objectives are in the US and the wider global economy, and that's to improve GDP. What we're seeing at the moment is very sluggish GDP. The last result's 2.8, but that was buoyed by the supply of capital expenditure from inventories. Exactly. So that's kind of been skewed a little bit. So we're looking really at a GDP growth of about 2%, which I don't think reflects what we're seeing in the equity markets, which we can come on to a little bit later. So I think we need to have a step back and look at what needs to be done outside of monetary policy. Monetary policy alone isn't going to get the US economy and the global economy back on its feet. So we've got to look at things like fiscal policy. And all we've got to do is rewind 2 months and look at the government shutdown. America really does have to look at its governmental structure and its legislation and really work out a fine balance between tax revenue and government expenditure. And until we actually get acquiescence between the Democrats and the Republicans on a way forward on that, I think you can throw as much money as you want to the problem, but it's not going to cure it. So I think they're the two main issues that really, really do need to come together, is monetary and fiscal policy, underpinned by a good communication strategy, because we've seen the reaction to the markets when Ben Bernanke maybe alludes to a tapering of asset purchases.
In May, yes. He shook the world and the markets, right?
He did, and interest rates spiked up by 1%.
That's right.
And then they've come back down again consequently because Yellen's obviously, given a slightly different perspective on the future.
Dovish. And he says, Mike, I'm sorry for interrupting you here, but even though we reached the targets, the targets shouldn't be triggers, by the way. He says, even after we reach them, he'll keep the interest rates closer to zero. He'll keep accommodating. So are we talking about QE forever? And then there were those academic reports that came from the Fed, academicians. They said, 6.5 could go down to 5.5%. Did you see that report? So the market is really uncertain right now. They don't know what to expect, but they're sugar addicted to this. And it shows hope for them. Unfortunately, in the long run, it is a very big problem because it's an unconventional thing, $4 trillion balance sheet. What do you think in terms of Yellen's comments? Even though Mark Faber, he said he sees bubbles, Yellen doesn't see bubbles. On what ground? She wants to continue forward. Is this healthy?
I think it's the million-dollar question. I think it's an absolutely fantastic question. I think there has to be a real understanding, and I'm not sure that the circumstances and the scenarios have been played out to full tune on what happens when you start tapering asset purchases to the wider economy. I think we all know that the markets are going to react negatively when it starts occurring. I think the million-dollar question
Will
is...
it start occurring, right, in December, like some other strategists still think? Are you one of them?
I'm kind of sat on the fence at the moment. I wrote a recent article in the Huffington Post about whatever happens, the markets are going to have to go through some cold turkey. So that means basically is that the markets are going to react negatively. The question that I ask is, how long are the markets going to react for? Because the markets at the moment are addicted to asset purchases. But if you step back, what should be driving the markets is the actual real core health of the economy. What are the quarterly results saying from the businesses? And at the moment, the quarterly results are improving. So I think that has to be taken into consideration as well. So going back to the communication strategy of when Yellen will indicate that tapering might start to occur, I think the timing of that communication is absolutely vital. Do you do it just before quarterly results? Do you do it after a healthy set of quarterly results? You know, it's a great question. There is a communication strategy that needs to be solidified from the Fed Reserve. And I think we need to understand what the long-term effects of the stock market are, but also identifying that what we're seeing in the stock markets at the moment in terms of all-time highs, which we've got across the S&P, the NASDAQ and the Dow, and the FTSE's up at something like sort of 6,700 at the moment as well. You know, we've got to look at what, or the disconnect between what these markets are indicating at the moment and what GDP is doing, because there's a huge disconnect. The markets are at all-time highs. The top 1% in the US are getting richer, but the middle class and the lower class, I actually think you're finding trending more middle class are actually being forced into the lower class, irrespective of the all-time highs on the markets. And I don't think the analysis there has been quite played out to what it could be.
Well put in terms of the whole economy and the outlook. Last 10 seconds. What is the correlation in terms of the emerging markets, which is your expertise? If we go downhill, like, you know, some people are expecting with the fiscal cliff ahead of us, what's going to happen to the emerging markets?
It's a great question. I think what we need to do is we need to look at the effect, for example, on quantitative easing on the emerging markets. If you look at China at the moment, China has been buoyed by this liquidity. It's gone out and it's made a lot of fixed asset purchases. What we're now, though, seeing today in China is an excess of liquidity, a huge excess of liquidity, and poor returns on capital. So it's not actually giving back the returns that would be expected. I think then if you look at the emerging market currencies, if you look at India, for example, India and the price of the rupee has come down 30% since April. That's having a huge effect on India's economy because India is a huge importer of oil. So it's costing the Indian economy more because of the effect of QE from the US and the Western world. So again, I think it's about looking at the more macro secondary and tertiary effects of QE and asset purchases on the emerging markets and how it will affect them long term, not just the US.
Including Turkey, and well put.
Including Turkey.
Love your worldly comments and your valuable feedback. We gotta have you back, Michael. Thank you for coming.
Thanks.
Evet, burada sohbetimiz sona erdi. Söz tekrar sizde İstanbul'da Hande.